is a position, or that's an execution risk. You could go as high as the Z3 line on the other one if you wanted. If you stack those two yellow boxes, that's a 10-cent risk for execution. The lower box is about 4 or 5 cents. But he put them both together, which is higher than, it's as high as yesterday's volume weighted average price. So you're up around Z3. That's 10 cents. And you wouldn't, if it started going down and then reversed and went all the way up through that, you would say, okay, it's probably not going down. So that's a good execution risk. And your position sizing risk is much wider to protect you against taking more than a 1-hour loss. And then at some point as it starts cascading and failing, all you got to do is get your risk out of there and, like a little mountain climber, tap it in protection. No lose plus dinner for two. Now it's a science project. How much are you going to get paid to stick around? Now you can refine your exit techniques. We'll talk about ways of doing that, but that's really the mind state. So I have no anxiety left anymore once I'm in that no lose plus dinner for two. Now it's really, I hand that off to a new, different part of me. Just here, you go see how much you can get. My job is done. My job is to, the first guy is to find the critical state. The next guy's job is to frame the entry and get in. Done. My job is to get it from no lose, is to get it from the initial risk to no lose plus dinner for two. Then the next guy, you figure out how much money we're going to get. And have some young wild animal that says, here, you figure out when we're going to put a second position on. So in terms of psychological states as I go through that, that progression, I can actually identify different parts of my personality that it takes to manage that part of the trade. And I think of it in those terms so that when I know where I am in the life cycle of that trade, I know what's most important to me at that time. Getting in means I just got to get in. I know you don't feel right, and I know you're experiencing the loss. You got to get in. Okay, your job is done. You got in. Sir?
How soon do you move your stop?
The question was, how soon do I move my stop? As soon as I can. I either trail it with the initial risk,
Okay.
or accelerate it if I think I can.
But would you be concerned about a retracement?
Unconcerned.
Which gets you
Unconcerned.
out of the trade?
Happens all the time.
So does that mean the moment the moment the price leaves the box, you would move the stop?
No, when it leaves the box. So let's say on this one, so suppose I get short right there.
Yeah.
And let's say I'm going to use that as my risk box, my execution box. I'm using the combination of the 200, the RL270, the VWAP, and about a Z plus 1. And I got in somewhere around between Z minus 2 and Z minus 3. So I got like 3 Zs in there. And so that turns out to be about 12 cents-ish. By the time it leaves that same size box the other way, somewhere around in there, somewhere around 1672-ish, I should be at no lose plus dinner for two. Now, maybe that little 1, 2, 3 retracement that stops inside the dragon, I'm pointing at it as if I have a laser finger. Oh, can't quite see it. So right in here. So that's the point of maximum excursion so far. And I got a 1, 2, 3 against me. It hasn't even hit the piece. Use the piece heart. The northern skin of the dragon is the noise buffer. That is, the spine of the dragon is a 10-period simple moving average. Plus or minus, and the dragon, the width of the dragon is plus or minus a half standard deviation. So the width of the dragon is 2 half standard deviations. So it's a full standard deviation on the 10. That's the noise buffer. And when the PSAR joins the northern skin of the dragon and it starts tracking down, that better be my stop or lower. There is no reason for me to have a stop higher than the PSAR, but I'm willing to move it lower because of reasons. Whatever moves me in the moment. Now, the next, I want you to look at the behavior of the RL10, the blue line, and the dragon. So once the RL10 and the price left the river, and then the 30 left the river, that's the beginning of trending behavior. That happens somewhere around, right about here, is where this is the beginning of trending behavior, right in this area. And then the RL10 and the dragon move together to the south, tracked by the PSAR and the dragon, until you get a, well, what we have here is an unambiguous move to the downside. Because from across the room, I would argue that was a directional move. The unambiguous move begins with the beginning of trending behavior. So when the price and the 10 and the 30 all leave the river, that's the beginning of trending behavior. That lasted for a while. That looks like, you know, 1, 2, 2.5 of those initial risks, something like that. Sometime after it leaves that first favorable box, and not later than the second favorable box, I should be at no lose plus dinner for 2. But as a rule of thumb, I like the northern skin of the dragon and the PSAR working together. And then what you'll notice is this. Somewhere in there, winter became spring. You know, when the signal line went back into the Red River, I would say something like this, right about this region right here. You're entitled to say, this is different. This price action is different than the previous 20 bars. The state just changed. So we're actually building an owl entry right about here. That's probably an owl right there. It might even be as early as this. That's probably the owl, was that third green dot. So the owl, unambiguous move, a P1, which is a RLX, or an RLCO, that's the 10 and the 30 cross over outside of the river. That happens right here. That's the second criteria. Third criteria, RLXD. The 10-period regression line crosses the dragon. RLXD. Regression line crosses dragon. That's that second green dot. So that's 3 criteria of the owl. Unambiguous move, P1, RLXD. Fourth criteria, the slope of the dragon must start curling up. So that happens.
Do you assess that intra bar, or do you wait for a bar close?
Let it close. You'll be all right. So somewhere north of that little, somewhere north of that little green dot, somewhere in here, that starts to curl up. And then almost at the same time, the RL30 starts to, it got to a point, and now the 30 has turned, the dragon has turned. That's criteria 4 and 5. Those usually happen within a bar or two of each other. The PSAR flip. The PSAR flip. Parabolic stop and reverse, framed with a, what is that? 0.02 and 0.12, is a tuned PSAR. It's tuned to where, over thousands of trades, where I found myself wanting to have my stop to feel good. It's informed by the dragon and the slope and the reversal. And then I would, on thousands of trades where I would actually put my stops, then look at a large data set of those, and then start fiddling with the PSAR values until the PSAR looked like the lines I was drawing when I was satisfied with my performance. So once I can take my intuition and feelings and put that into a repeatable code and let math do that, I can now just put that on there and say, well, my stop better be at the PSAR or better. Like, I should have, why would I have a stop further away than what the PSAR said, which was my standard routine practice over thousands of trades that I was very satisfied with? It now makes me ask the question to myself, why, adjust my stop to the PSAR, then ask myself, why did I feel it important to have a wider stop? Because I really wanted this thing to work? What does that have to do with how it's going to work? Nothing. So that was just a thing to notice and say, okay, I wonder why that thought came into my head and where it came from and what was the trigger for that. But meanwhile, the PSAR is doing what it's supposed to do. Now, there are times when my trader quality number, my intuition, my risk-averse inner chimp says, preserve more of this move because of reasons. Hey, the rest of the market has started to turn, but this thing is still working, the last vestige. So make sure you capture as much of that as you can in case this thing finally joins the rest of the market. So I could override the PSAR in the direction of reducing my exposure, but not to the point where I said, no, give it more room to run. If I ever see myself doing that, I should just cash the trade and take what I can, because as an alternative to my emotional state. Try that sometime. See what go against yourself. And I don't know. Anyway, so the PSAR comes about from many cases of managing those trades and trying to find the trade-off between giving back too much and getting too close and finding some manageable medium. And that's what your job is to find a professional rule that allows you to be satisfied that you simultaneously gave it room to run, but also preserved your gains. That's a trade-off decision that you got to make all the time. And whatever the results were, there's going to be an emotional response to that in your head and in your heart. And that is an emotional charge. And before you go to the next trade, you have to get back to the zero state, which is being able to trade purely and properly and professionally without any legacy feelings carried over from previous trades that are going to influence how I execute my trades. That's what I mean by the zero state. Not the absence of emotion, but to be in an emotional mind state, ready to trade properly according to what you see and what you do, and not trying to make up for previous. That's emotional charge that carried forward. And it can come from two sources. I gave back too much, or I made so much that now I'm amazing. And I'm going to carry that emotion into the next trade and change my rules because of how I feel. Let me know how that goes. Ever been there? You may have heard of other people that had that experience. So I have to be satisfied with the way I exited so that that can be just what it was, and I can go to the next trade ready to execute my plan the way I always do it without any carryover effect of emotion. Now there may be information from there about, hey, where it stopped and how far it came and how many legs down and what else is the market doing and how much time is left and what's the pattern. All of those things. That's information that a professional would use. But the feelings about, oh, I did that right or did that wrong, and I'm going to use those feelings to influence how I act on the next one, that's unprofessional. So you got to get to the zero state. So the question about when do I move the stop and how do I adjust and all that, however you decide to do that, and I just suggested a couple ways to think about doing that, is it's more important how you come out of that with a professional feeling that you can just continue to operate the rules as you design them so that you can gather 30 trades with those rules, executed with the same mindset, so that you can now study the histogram and say, here's what that basket of 30 apples produces. I don't want to get in here and start changing all the rules on each and every trade based on how I feel from the last trade, because then when I get 30 trades, I have 30 individual experiments with one data point times 30. Because I was a different person, different rule sets in those 30. I got to be able to execute like a robot, like a craftsman, 30 times, then I will adjust my feelings. I say, hey, overall, I got 35% of the available move. You can make a living on 35% of the available move, getting 1/3. So if there's 3 legs in the optimal move, I see 1, I plan for 2, and I hope for 3. But if I can get that middle leg, like if I can see, I was going to point, I can't do that for the streamers, but if I see this first leg, if that was my execution, I see 1 move from here down to here, so I'm in, plan for 2, hope for 3. Man, by the time this gets down to this green dot, whew, I'm good to go. I like that. That's probably a 0.6 win right around there. And then just a routine exit. And I got to make 2R a week position sizing. 2R a week times 50 weeks is 100R a year. I get a net 2R a week. That's 0.6R today on 1 symbol, on 1 move in a half an hour. And my span of control is 4. I can manage 4 open positions with money on them. That means 4 individual symbols with 1 bullet, or 2 positions with 2 scoops on them, or 1 position with 4 bullets on it. So I start the day with 4 bullets of $400. That's my daily R. I'd like to net 3,200 that week. So I put 1 bullet on that thing, and I've got, 10 cents of risk. Position sizing, 50 cents. So 800 shares. 800 shares and make 20 cents. $160. Bank, 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 bank. And just, so after I get 30 trades like that, I can now say, am I giving back too many, or giving back too much, or I got too close? And if I got too close, all that means is that in retrospect, this thing reversed again and kept going in my direction. All that means is I have to make sure I have a way to re-enter a trade that I got out of. So I know how far it could go intraday, maximum reasonable intraday move from the open, or the high of the day. That would be the range stat. I take the range stat from the daily report, find the high of the day, drop a range stat. That's where it can get today uncontroversially. So if I get one leg and I get out and then it starts again, this is simply if I had gotten out here and then took this owl entry, a failure below this belly of the dragon, like right here, is a short. That's a collapsing dragon. That's stop and reverse. So if I had done that, I end up losing 2 cents. That's 2 cents on the owl. Okay, 2 cents. That's 2 cents times 800 shares is 16 bucks. Round trip 20. So that's 1/20th of an R. I am not losing any sleep on that. I'm not even thinking about that. That's just the cost of doing business. That's just poker chips. Put in my ante, no cards, muck it. You got to muck 70% of your hands. So when I'm trading well and I'm aligned with the market and it's behaving in a normal way, my win rate should be about 0.6. My scratch rate should be about 0.3 or 0.2. And my loss rate ought to be about 0.2 or 0.3. So I ought to be winning about twice as many as I lose, and my average win to average loss ought to be 2 or 3 to 1. 40 times a day. Traded at a level that I can just play it like poker chips and generate a lot of case studies and ways to refine the standard practice of how to adjust the PSAR and how soon can I get in and how narrow can I make the minimum manageable risk box. I don't want to take more than an execution risk, much less a position sizing risk, but so that I don't lose my mind and try to pick the best one to do and really be massive on that one. Like I'm not going to take 400 bucks and divide it by 10 cents and come up with 4,000 shares, especially like in silver. You know, one guy comes in with contracts in the futures and this thing explodes. So that would be a bad thing. So instead of trading silver on the short side, I'll go ZSL, double inverse silver, and go long so I don't have to borrow shares. That reduces the amount of risk of shorting. Or I can just go to silver Wheaton, which is a leveraged silver and precious minerals play, and just play him because he's very liquid and moves independently of the market, but tracks the precious metals indexes really well. It's an old reliable. It's a swing champion and a frog champion.
Which one is that, sorry?
Wheaton Precious Metals, WPM symbol. WPM.
Thank you.
So if I saw something like, oh, 2 weeks ago, market was horrible, horrible, horrible. Gold made a 4 sigma move to the upside and then started to peak. And that's when all the media was hitting, gold is back and buy gold. And that's guys trying to sell gold that they had made money on. Somebody buy my gold is what they, when they say you should buy gold, they're saying you should buy my gold so I can buy it back from you later when you're disgusted. So when that was working, silver Wheaton was better than gold. And when gold and silver started to fail, Wheaton Precious Metals didn't fail as fast because there were some people that were believing in Wheaton. So that gives you an orderly exit. Gold and silver turned. Wheaton was starting to hesitate, cash, and give back almost nothing. So, winter, spring, from a winter into the spring, signals, that's owl territory. Now, at one of the research weekends, so I just got to say this because it's in my head. So, at one of the research weekends, one of our traders who's a electrical engineer, he was studying the Russell 2000, the futures and the ETF on tick charts up to 1 minute charts. And what he discovered was that this little RLXD, that little moment right there, which is the third criteria of the owl, what he's looking to do is he wants to enter as on that third criteria. He wants to buy the RLXD because what he discovered was in the Russell, over the 4 months that he studied, 85% of the time, that thing will close higher in the next 3 to 5 bars. So the RLXD is good enough to get in if you're trading on shorter time frames and you're willing to just grab what you can and get to no lose quickly. So you want to be very, very tactical intraday. So you can get well started, and then it either works or it doesn't work. But you can get well started and get your risk out and say, let me just buy. It's like buying, not even buying a lottery ticket. It's like somebody that, here's a free lottery ticket. And you open it up and say, oh, well, that didn't win any money. Well, I don't want any more free lottery tickets. Stop giving me free lottery tickets. Here is a bucket full of unshucked oysters at no cost to you. How many of those do you want to open? All of them. Or I'll pay a kid $5, here, open these oysters. And I'll split the pearls with you, whatever. And then check that guy's ability. Start doing the stats on each bucket of oysters. What's the expectunity of buckets of oysters? So you got to, but you have to have standard processes in order to apply statistics. So the answer to the question about when and where is just whenever, as soon as I can, I want to get my risk out. And my standard practice would be, take a look at where that PSAR is. You know, if this is my entry, that PSAR starts right there. And just follow that all the way down and out. That's the RLXD exit. Right? So if I wanted to stop and reverse with an owl, I might have stop the one trade there and enter there. But I'm satisfied with an RLXD exit, because I gave it some room. You know, it made a maximum low. The 10 turned. It did a P1. I could get out on a P1 exit. Or I could wait for the RLXD, or I could wait for the owl. So there's a little ladder of decision making in there as you start appreciating that pattern, and you can start making decisions in there on the basis of the technical indicator. Or you could just take a look at the how much money do I have in hand indicator, and how much of that money do I want to give back indicator, and watch the P&L and just, I wouldn't object to that. I don't object to that. In fact, I embrace that, because that's my money. And if it goes all the way back to where I got in, that wouldn't surprise me. A return, fair value on this thing is variously, at this moment, fair value is, well, the Bollinger Band mean. It could get back to there uncontroversially. It could come back to the VWAP, the volume weighted average price. That's the mathematical correct price that day so far. So if it got back to the VWAP, it's doing what mathematically it's supposed to do. Because everybody that's trading that intraday with leverage, and if you're a broker trading that on behalf of a client, he's going to reward you with half the gains that you make on price improvement better than the VWAP, and he's going to penalize you for every price that's worse than the VWAP. So you're happy with the VWAP. You settle up your accounts on the VWAP. So if I'm down here and I'm holding this money and it's coming back and I get the RLXD, it could go to the 90, to the Bollinger Band mean, to the VWAP, to Z1, to the RL270, to the 200 period moving average, and to the previous resistance that started this whole mess off. Now you decide how much of that you want to give back, knowing that you entered right here. And so it goes down, and now any move that comes right back like that would be unsurprising. So you just decide how much of that money is yours. So I want you to suffer with that decision. But the little markers that I recommend you put on here to help calibrate these moves based on stats would be things like the northern skin of the dragon. The PSAR is just good. It's good. You know, the RL90, that green line, that's the 30 period regression line on the 3-minute chart, because I'm looking at the 1 minutes. So the 1030 is how I'm judging the RLCO framework. The 3090 is the 1030 on the 3-minute chart. The 270 is the 30-minute, or is the 30 period on the 10-minute chart. And the VWAP is the VWAP, sort of what it is. Now, I want to talk about the MACD lines. Yeah.
I have a question about this stop.
Yes, sir.
In this move, it's a pretty smooth move.
Yeah.
It's not very choppy.
Right.
So how do you manage the stop?
PSAR.
PSAR. When it
Trail it with the initial risk. You make your risk and put that risk on it and just trail it. And with the PSAR, whichever comes first. And at some point, when the PSAR, what's this? Technique. When the PSAR picks up, +1, then instead of trailing it with the execution stop, I just use the PSAR at that point. Because the PSAR is the one that says, oh, that move was over. In fact, when the PSAR crosses your entry, so if you remember my entry level was, oops, sorry, wrong one. My entry was here. By the time when the PSAR crosses that line, that would be your stop, or your break-even stop-ish. So somewhere by the time when that hits there, I should be looking for where can I get my no lose plus dinner for 2 in here. So 400 shares, and I got to make $100. So I need 20, and I'm 400 shares, $100, 25 cents. So somewhere around 1660. Yeah. So not later than here. So that's about 1660. That's 25 cents in hand. That's $100 in hand. That's when I really feel happy and safe. So now it's how much of that do I want to give back? So I don't. So that little RLXD entry or exit right here is not bad. That captures. Let's see, 65 cents. Yeah, that's about 80 to $100 up in there. So we said now over here where this thing comes back and hit. Damn it. So now the belly of the dragon, this line right here, just draw that across on breaks below that line. You now have a collapsing dragon. Let me tune that a little bit here. So the owl entry is approximately there. Now, do we see that? So if I'm in the owl by that time, my stop should be approximately there. My execution risk should be approximately there. But the break of that red line, the belly of the dragon when it goes across, I would not be offended if you had just gotten short there. That's probably where I get short on a normal work day. That's a 10-cent risk box. I'm not going to take, and that's just my execution risk. So 10 cents, 400 shares, standard size. That's my 10 cents. And now if I didn't get short there, I have to get short here. And so now we're 20 cents in hand on that thing. Lather, rinse, repeat. Same dimensions, same move. It's even easier because it's later in the day, and now the opening book is over, and now we're into the day, and we're 2 hours into a 7-hour trading day. And now I simply consult my range stat box from the daily report and say, how far can this thing fall in one day? So I want you to notice the difference between sideways quiet channels and Z3 pinch and breakouts from Z3P quiet, and using the far side of the Z3 box when it pinches as your execution risk to at least go the other side. Figure out what the size of that box is, straddle the open with it, and now you can start playing directional moves right from the opening. And all you got to do then is get your risk out of it by moving to no lose plus dinner for 2, or just some move that gives you no risk to your initial capital. And then just see how far it could go. I'll look at the daily report to get the range stat on silver and figure out, I don't even know what it is, probably $1. That thing could move from 17 down to 16 in one day in an unsurprising move. So there's another 50 cents below. It's only moved half a range stat right now. When you're in the middle of that, it feels like, God, it's such an enormous move. No, that's one leg, hesitate, 2 legs. There's another one of those legs all the way down. So I would say to myself, why don't I have where was I not getting that? Why didn't I get that second position in? It fell down, didn't even challenge the dragon, and then started making new lows. What the hell? I mean, what the heck? Pardon my language. That's an example of the kind of language we would not tolerate at my house or in the classroom. Unprofessional. So now I get two scoops in with momentum. I'm clearing the deck of all the other, because my focus is find the mover, get in, get to no lose. Where's the second position? Now I got 4 bullets. I can manage 2 positions with 2 bullets in, or 2 with 1 in and 2 bullets ready to reinforce. Oh, this one's really working. Clear the deck. Grab it while it's being made. Now I have to have a stack of symbols, all of which are postured to make larger than normal moves today. And now, what's the market doing? Which way did it gap? What sectors are winning? Use intraday relative strength to find the movers, get on them and focus. Take what I can, set it aside, lather, rinse, repeat. 40, 50 times a day. So you have to have some kind of work norms or standards of practice of just use the PSAR and stay in it until it feels like it. Hey, just get in, whatever. Trade it. I sent one around from Charles. He said he's using a combination of 5-minute and 1-hour charts. He uses the 1-hour chart, which is that hybrid between swing and day. Finds critical states on the hour, frames the trade on the hour, dials down to the 5-minute, gets a good initial entry position, tries to get 2 positions in, 3 positions in, cash 2 of them, convert the last one back to an hourly chart and kind of manage it from there. So he's using the hour to set up. It's a slow day trade or a fast swing trade, and uses the 5-minute to fine tune. And so he's not living and dying on every single little tick, but he can manage that really well with his newborn baby and new wife, and recently changed jobs to full-time trading, and moved his house to California. So on the cumulative stress event inventory index, so let's keep it simple on this. And he trades with his baby on his lap, listening to Mozart, trading with hour and 5 minutes on the Russell, the S&P, and oil. 3 things, all big, fat, liquid, multi-directional, being moved by massive amounts of money that are moving somewhat independently of each other. When the S&P is up and the Russell's better, Russell. S&P's up, Russell lagging, S&P. S&P's doing anything and the oil is collapsing, oil. S&P's doing anything, oil better, oil. Get his risk out, ride the wave. Lather, rinse, repeat. So, to answer the other question, you got to have rules that you can apply just time after time after time after time so that you have a data set of standard practice so now you can do continuous improvement by adjusting the exit management. The entries, just get in. Just get in. Doesn't matter. In fact, in the middle of that sideways quiet channel and it's right on the Bollinger Band mean and you're waiting for it to break out in either direction, just buy it or sell it. I don't care. Whichever way, half the time you're going to be right and you get a half improvement because you're already in and there's no slippage because it's right in the middle. Go with the primary trend of the day. It was up and now it's pulled back and now it's sideways. Just buy it right in the middle of the river. And then sell it if it breaks out of the Z3 pinch box. Instead of waiting for the breakout and then try to chase it and get the slippage and then a head fake, just short it or get long of it. Doesn't matter. And then let the move happen. And you won't get any slippage. It'll take you, and now it's direction. You say, I wonder how this is going to. So that's a coin flip. Get in with a coin flip and then manage properly. If you have an opinion about which direction feels better or whatever, have reasons, okay. You know, that's a marginal, you might improve your win rate by 10%. You know, the amount of information that's in that Z3 pinch box is so small that even that little improvement won't make a huge difference, but it'll feel better. You know, so you got to beware of the feelings. So, like right now, if I got 2 in and I see that, what am I? Cash. Make the bricks. 0 state. Now I'm ready to go. Now, if I cash that one right there, I mean, don't I have to just put a box like this on it, I guess? I'll even stay with that one. If it falls out of the bottom of that box, I better be short. And if it breaks out of the box that way, I better be long. On the upside, where's it going to go to? That red line, the VWAP, this cluster. I'm pointing like you can see my finger again. So it's going to get to this congestion area. If I just put it right over in here, that's about right there. It could get there uncontroversially. It could get to the VWAP. Now some magic on the upside. Now I'm going to compare the RL10 and the VWAP. How far were the traders able to move it away from the mathematically fair value? I don't know. Let's see. I'm going to change this color to orange so that we can see it. So the furthest excursion from the VWAP to the RL10 where it turned, the first time was that one. Would you agree? Try to make this stand out a little better. So you see that excursion? Oh, it has now moved a little bit farther. So that's how much power they had to move it. Now that tells me something. That second wave was stronger than the first wave because they moved it further from the VWAP the second time. So there might be some more left in this thing on the downside. Short. So how far could it go on this one? Well, let's see. This is about how far they moved it the last time. Would you agree? Then the second time they moved it about that far. So I think they could move it that far. Wrong line, sorry. I don't even know what that thing is, but I like the looks of it. It's some kind of, it looks like a mortar round impacting the ground. So that's how far they could get. So now what I can do is I can go to my daily report, find the range stat on silver, hang it from the highest high, drop it down and say, incontrovertibly, it could go that far. Now, that's the maximum reasonable intraday move. I need to know that for every one of my symbols. I also want to know what is the maximum excursion of the last 200 days. That's going to be bigger than the range stat. But there was a day in the last 200 where we had the biggest percentage loss intraday of those 200. It doesn't surprise me if that's twice the size of a range stat. So when you see something that gets to a range stat and starts failing again, you say, whoa, this could be one of those days. If I have traded properly, I've got a couple R in hand in an open position that's still working with a tight stop that preserves my professional gains, and I might have two positions or even a third position in as it goes out into the land of irrational exuberance. The movement from the quiet zone to the range stat is the range of rational exuberance. Irrational exuberance begins at the range stat and beyond. So here's the information I need to know about my targets. How far on average does it move on the range over the last 30 days, 200 days? What's the furthest that it ever moved? What's the furthest it will ever move into the future? That's the one that's hard to know. But I can know all the other ones and get an estimate of the size of the moves that my preferred target makes. Sir, question?
Would you take the outliers out of your calculations?
Yes. And the question was, would I take the outliers out of the calculations? Provisionally, yes. And here's how I do that. By computing the range stat on the basis of the last 30 days, I'm using only the most recent memorable moves. Any outlier that's in there is defined as anything more than one standard deviation above average, and mathematically, that gets computed in the standard deviation. It tells me what the outliers are, and so when I establish the range stat as average plus 1 SD, it tells you the size of the move minus the large outliers. That's the maximum reasonable intraday move that I could expect. So the outliers of 30 days are anything beyond a range stat. That's beginning the land of irrational exuberance. Now what I want to know is, what is the range stat on a 200-day? Because that's kind of the long-term frog box. And then what's the maximum excursion in the land of irrational exuberance? Now what I want to know is, I really want to concentrate on the outliers, because the size of the outliers tells me about the potential for runaway freight train. I don't know if you ever saw a semi-trailer going up a hill and lost his brakes. That's a bad thing. Been in one driving it and lost my brakes. Been in one driving it with 30 tons on the back, and it had just come out of the shop, and the guy didn't put the cotter key in, and the left front wheel fell off as I was leaving the installation, getting ready to go on the expressway. And thankfully, I was only going 20 miles an hour at the time, and the wheel went rolling off. 5 minutes later, and I'm doing 70 down the highway, and that happens, and that would have been worse. So it's important to know the outliers there in the side, but most of the time the wheels don't fall off. So the range stat is a way to calibrate the maximum reasonable moves intraday, and then the outliers are part of the land beyond. And now I want to know what the outliers are so I can see. There are days in Alcoa where its maximum move over the last 200 days is 4 range stats. And that's a time when the whole market was horrible and the material sector and the business cycle was bad, and aluminum was cheap, and now all of a sudden the switch gets flipped and guys start locking in long-term contracts to buy aluminum cheap, which starts the turnaround because they think the business cycle is going to, and this thing just off it goes, and everybody got on board, and that thing moved 4 range stats intraday, and that was a 40R trade, but traded in the usual way, fighting for pennies, nickels, and dimes and quarters, and locking in pieces, and it just kept moving, and it just kept adding a position with markets money, and got 4 positions in, and it just kept going. I was like, oh, okay. Not bad. There was a live trading workshop here some years ago when silver was working, and in a 3-month period went from 20 to 53, and we did a 60R trade live on film in this room, and it should have been 120R. We were 12R into it with one position and said, and everyone's going, wow, this is so man. I said, why don't I have a second position on? So I finally got one on, and then we're holding 25R, and it's still going. I said, why don't I have a third position? So just by being surprised by the outliers or not having thought through the contingency of a catastrophic success, I was slow to get those extra positions in and lock in the no lose. So the big trades for me now are ones that start off, they all look the same leaving the station. And lock those pieces in, and 2R battle drill to routinely get out a 90% or 95% of the trades. But sometimes it just happens. So I always have that on the swing trade time frame, the mechanical entry which says, oh, it got out of that noise and this thing is off and going. So that one always is there as a reminder, yeah, that's the point where you got to be large or larger. And I can do that intraday or just let the swing trade add to the fire and start shoveling coal into the fire, let it go. Now I know we said we were going to come back and do introductions, but it also felt like since it's normal that we do Saturday, Sunday, Monday, but today is Friday and the market is live, and so sometimes there are things that you can show just because the market is open that we can fill in the gap Saturday and Sunday. So if we're going a little bit out of sequence, it's because of that reason. That sometimes you can learn it while you're fresh, and I haven't beaten you into submission with theory and slides and all that other crap. Sometimes seeing it live is a way to get it at the visceral level. So, and it's now 5 minutes after 12, and this would be a natural break point for an hour lunch, if you would concur with that. Does that seem reasonable? And we will, honest to goodness, try to do a introduction. I think we're going to defer the introductions till after the market is closed just in case good things happen. And we'll get that sorted out. Fair enough? Okay, so it's 12:10. We will start not earlier than 13:15, not later than 13:30. So, going once, twice. I would like you to think about over lunch about 5 things. Best thing, worst thing, aha moment, biggest surprise, biggest question. So those are the things I'd like you to be thinking about. And with your partner at lunch, because they can't just let you eat and then just enjoy the moment. You got to be thinking, right? So our standard debriefing is best thing, worst thing, best takeaway, so something that could be immediately applied right away. I can use that in my trading practice, that insight. I already feel good enough about it I know that it fits. The aha moment is the surprise. Never thought of it that way. That's the other. So as successful adults, and you're successful because you can afford to come here. So you've developed standards of practice and estimates of the future so you can attend enough, but without, you provide sort of a minimum attention, and then something is said or happens that changes completely what you thought was going to happen next. Some moment of surprise. That always leads to a review of some assumption or belief or experience or something about the world didn't prepare you for what came next. So there was a disconnect between your model of the world and what you expected was going to happen next. And so that's always an interesting reverse engineering. Why was I surprised by that? What was I expecting to be said? What actually happened? How big is that surprise? What assumptions or beliefs does that test? What's the evidence for it? So it's always a very interesting beginning to an inquiry. Sometimes those things pay off. Like the moment I was sitting in the back of the room and Van was talking about system quality number, and I was just waiting for my turn to talk. And so I was doodling and I started thinking, I wonder that if you had a black box, by the way, the fifth thing is the biggest question. And I was sitting in the back of the room, and I said, what if you had a box and it was a black box? And out of that black box came a series of R multiples. X, Y, Z, A, B, C, whatever. And then if you had a large enough set of data that came out of there, you could then put statistics on it and say something about the stability and the quality and the reliability of whatever was inside that box rattling around and making R multiples. And on the basis of not even knowing what that thing is, but based on a string of results, you could even just trade the R multiple histogram. You would be taking risk I didn't know it was in the box, or how long it's going to stay that way, or what the components are, and is it going to break, is it overheated? So there's risks associated with not knowing. But how much about the universe do we actually really know? I don't know. Different question. Well, what if you opened up that box? Well, actually, you could take that string and you could do a system quality number, which is the average R divided by the standard deviation, normalized by 10. So if you had 100 trades, you would multiply it by 10. So it's either square root of n, the square root of the data set, or you just normalize it for 10 to compare things on the basis of 100 sample trades. So this multiple times average R divided by standard deviation gives you the system quality number. And Van's work shows, based on that number, which is nothing but a student t-test, it tells you how confident are you entitled to be that the process that produced that string of results is stable and normal and natural and reliable. The higher the t-test, the higher the SQN, the more confidence statistically you're allowed to place in the future looking like the past. In other words, how good is this sample as a predictor of the underlying population? Now that's true with parametric statistics, but if you have non-parametric statistics or non-normally distributed numbers, you have to use a little more caution. So be judicious about how much confidence you place in the reliability of a system simply on the basis of SQN, but it's a data point. It's something you should consider. So I said I could now put a SQN on whatever it was that was generating those numbers. Now I'm just curious. Let me open up the box and peer inside. And guess what I saw? I saw a hedge fund that had some set of strategies and rule sets and mixing that, and then as a result of their net portfolio performance on a daily basis, it had a string of R multiples. I opened another box, and in there was a rule set, there was a system, somebody's rule set, like the 5-day down plus continuation and short it in a bear if it fails. Or Kim Anderson's bounce system, or the Anderson regression line stretch, P7, or Gabriel's, whatever the thing is. So some rule set that produces a string of R multiples. Or it's Home Depot. And the R multiples are the percentage gains and losses compared to its starting price, and that the R 1% was 1R or something like that. So you can actually evaluate ETFs or hedge funds or actively managed funds or hedge funds or traders or system rule sets or individual stocks on the basis of SQN. So if you took all of the members of the Dow 30 and did an SQN on them and ranked them by SQN, you might say, I would like to trade the ones that have the highest SQN because they repeat themselves so often and reliably. Or I might want to trade the ones that are the lowest SQN because they have this crazy volatility. I actually might want to do that because I don't know which way it's going to go, but it's going to go large. So you might use the SQN as that might be an aha moment. That I thought about that idea and it seemed really, and it was not, and kind of follow the trail and ended up going to a place that completely surprised me. Or another day, I'm sitting in the back of the room and I said, he was talking about beliefs and how all you can trade are your beliefs, and that trading is 130% psychology. So it's like leverage psychology, I guess. I said, oh, crap. Yeah, right, okay. Trying to figure out where to enter and where to put my stops and stuff. I said, well, it's an hour before it's my turn. Let me just list all of the beliefs that I hold to be self-evident. Okay, all men are created equal. Okay, got that. Now, do good analysis, have confidence in your analysis, ride your winner, go long the strongest stocks in the strongest sectors, hold your confidence through periods of pain and suffering, let your winners run by giving them wide room and all that. I said, well, what if I took the exact opposite of every one of those beliefs? So I would be looking to try to go long the weakest stocks in the weakest sectors when they're horrible and have tight stops and look to cut and run as soon as possible and have no belief in the system. And it's a couple of things. And turn those into some operational rule sets and trade that and see what happens. It's one of my best systems. By completely violating every belief that individually there's evidence for why that's a good rule of thumb. But under certain conditions, that turns out to put you on the wrong side of a trade that nobody else wants at the moment that it's turning, and when it wins huge. That was it's called the washout pattern. The first best time that happened was in 2003, after the internet bubble blew up, and on March 9th, 2003, the market bottomed, and 2 days later there was a washout pattern, and that thing returned 140% over the next 18 months and had opportunities to scale in 7 or 8 times. Just because sometimes it works. So, aha moments and surprises are always the first step in what may be an interesting investigation. No, sometimes a cigar is just a cigar. Sometimes a cigar is a smoke. Churchill. So I would ask you to think about best things. Now, okay, I just call them the worst things, but in the kinder, gentler, the least effective things. So what that usually means is because the way I presented it was illogical or out of order, or it was a bad metaphor, or it wasn't clear. And so it was always, the way I taught it was intended to do something, and the underlying idea was important, maybe just the way I taught it was not right. So when you say, hey, this was the least effective thing, then that helps me find ways to better communicate with the particular students and maybe in discussion, oh, here's how I understood it, and we can collectively get better. So this is part of you helping me be a better teacher by helping me understand what wasn't working, so at least you can understand why I was doing it. Maybe I can do something else. So, best thing, it's clear. We'll do more of that. At least try to understand and maybe try a different way. Best takeaway, put it in your kit bag, put it into practice, document your decision, adjust your process, measure it, and make sure you follow through with it with accountability. That's what the chat room and coaching and accountability partners here does for you, is because you don't want to lead them astray, and with accountability we do things that we would take a risk for on ourselves. So I learned that by looking at how I give assignments to people in the military college. And their lives depend on mastering doctrine. So I divide up the readings into 4 and say, you 4 read reading A, you read B, you read C, you read D, and we all read E, which is the baseline. And you 4 got to read that and come to class with what everybody else needs to know, because their final grade, and their lives later depend on you telling them what they need to know. So you only got to read a third of the material, but you better study it. And then we're going to share that out, and each one teach one. And what you guys don't understand, I'll try to help and get to a better understanding. So if a guy were to be told, read all of those readings and then come to class, they might accept risk on their own knowledge. Say, you know, I think I can survive contact with that. I'm willing to take that risk. But if they know that their partners are relying on them to report the fact, they will do that reading for their team that they might not do for themselves. So knowing that, I shamelessly exploit them by binding them together into a collaborative learning environment, because I can. And plus I know that that's how they will actually do the readings. And by reducing the reading load by 2/3, now they have the energy and the willingness, and they get in, and then we learn how to collaborate together, and that turns out to be how Army officers at high levels actually plan and work, because there's so much to know, you can't know it all. The best you can know is 30%. But when you get 3 or 4 people and start mapping the 30% that they know, it starts covering the area, and then trust and collaboration creates insights that are only available through that style of learning. And so the way I teach is to leverage some of that with adult learners. And to offset the risk, I just say, look, you have unlimited free trial forever, so whatever questions you have and it's not clear, I'm yours until you're satisfied or you're tired of me. And then if it adds value and decide, okay, then subscribe. But until then, you've already taken all the risk. That's how I operate. And so the learning ecosystem is really to help us all learn together at our pace and in our way, and sometimes it's lecture, and sometimes it's slides, and sometimes it's doing, and sometimes it's accountability partners, and sometimes it's practice, and all that stuff. So the ecosystem is really a learning environment. I want to talk about that when we come back after lunch. But what I'd like you to think about in the short term is these. Best thing, worst thing, best takeaway, biggest surprise, and then the biggest unanswered question. We'll just keep a running list of those, and then each day we'll start the day with those, and in small groups to try to answer each other's questions, and the ones that are really of interest to the wider group, that's what we'll start in the morning with those. But that gives you all day and tonight and to kind of sift through it, and then bring really good questions in the morning. That's what we will do with those questions. Fair? So now it's 12:25. So we will start, again, for those of you in Radio Land, not earlier than 1:30, not later than 1:45. So think of those 5 things, and we'll figure out what to do with that when we come back. Thanks, guys. Well done. Thanks for hanging in there.